Let's start with the Fed meeting, because when I put out last week's episode, we knew there was going to be a Fed meeting in between the time that I recorded that episode and we released that episode last Friday. And I was really hoping that we would have a dovish tone from the Fed. And that is not what we got. We got, I would say, a relatively hawkish tone from Jerome Powell. Now, as suspected, no change to the overnight cost of funds. The Fed funds rate stayed exactly the same. But here's what was interesting. As you know, dual mandate from the Federal Reserve, full labor participation, full employment, and keeping inflation in check, and sustaining the price of goods. So let's talk about the labor market really quick, because we've been talking on this podcast, and if you watch anybody who's gives commentary around mortgage interest rates and the Fed and all of those things, there has been very dismal jobs numbers as of late. And the most recent BLS jobs report was, negative 90,000+ jobs. So, we look at that in comparison to what the trend had been, and we're like, man, those are horrible jobs numbers, right? But what was interesting is the take that the Fed put on it. And they put a lot of emphasis on the fact that there is significantly less job openings, right? And I get it. We've talked about this a little bit with the advent of AI and seeing, efficiency and productivity go up with organizations. What we see is not a lot of firing going on, but also not a lot of hiring going on. So we've talked about that, and the Fed brought that up in his Q&A. Also, the immigration, right? We have a lot less folks that are looking for jobs because many of those people have, been deported due to the immigration policies of the current administration. And so the thought being is that because of the impact on immigration, we don't have people coming into the country. We have some people going out of the country. And we see this overall efficiency pickup that basically what I heard Jerome Powell say was, even if we were at zero job growth, that would be sustainable for maintaining low unemployment numbers. And that's really what they're focused on, is the unemployment number. So this is kind of a shift, right? What it tells us is that we can no longer look at a BLS jobs report, and if that number is 20, 30, 40,000 jobs, and go, oh my gosh, we're used to seeing 150,000 new jobs, 200,000 jobs, because that's what was necessary at the time. What the Fed is saying, and really, in my opinion, downplaying how weak these jobs numbers have been by saying, yeah, but there's not as much need for those jobs. So therefore, it's not really going to impact employment. You guys, this was a pretty significant shift, in my opinion, about how they're looking at these jobs numbers. And I think for those of us in the industry, we need to, whether you agree with it or not, I think we need to recalibrate our expectations on what sort of market movement we might expect when we see what is, historically speaking, low jobs numbers. I think that's what's expected now from the Fed, and that is not really going to drive their policy. Now we start seeing, negative numbers month over month. Now we're talking about a different story, but I think that the expectation that if we don't have 100,000, 150, 200,000 new jobs, it's going to be looked upon negatively. It did not sound like that was the case in what Jerome Powell said. So that was a big shift there. And then, of course, there was lots of questions about inflation. He's still talking about the tariff inflation that we, in his opinion, have not fully seen work through the system. He talked about 12 to 18 months before we saw the full impact of that. And with those, we're just coming up on 12 months now since, the majority of these tariffs were put in place. So we're kind of getting close to the 12-month mark. And he's saying 12 to 18 months. So we're probably another 6 months out before they feel like all of the settling from the tariffs is worked through the system. and we kind of have a new baseline. Obviously, the conversation came up about the current price of oil, right? I mean, the war had already started at the time that Jerome Powell was doing his Q&A, and definitely implied that we would see at least some short-term inflation pressures as a result of oil prices going up. This is not a surprise, but when you combine those two things together, kind of the dismissing of the weak labor market and acknowledgement of the potential for increased inflation, it came across as pretty hawkish. And as a result, the market reacted very negatively on that day, and rates got worse. Now, you compound that with what's still going on with this war, which is now lasting, I would say, longer than most people anticipated, and having a bigger impact on the economy than anyone anticipated because of the shutdown of the Strait of Hormuz.